Today's sessions is intended for educational and informational purposes only, and participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. PU Prime and I hosting the sessions are not liable for any losses or damages resulting from the use of the information presented. Participants are responsible for independently verifying information and considering their own financial goals and risk tolerance. Hey, this is the disclaimer. So, yep, as you can see here, today we have discussed as Forex and Commodities Demystified. So basically is today I will just discuss with you about the dollar index, the DXY, which is the US dollar, and also its relationship with the most commonly traded commodities, which is the gold and also the oil. And yep, let's dive in. So yep, this is the content that we're going to cover today, the factors that impacts on the USD, the relationship between the USD and the USD denominated assets. And lastly, if we have time, I'll just update you guys the important event for from today until next week. What are the key economic data that you should keep an eyes on, and also if we still have time, then maybe I'll discuss the recent trend with you guys. So yeah, USD and the Forex market. Why we particularly need to discuss this USD? So I would say, I think definitely more than 80% of us trading, day in, day out, in the CFD industry are involved with the CFD. I mean, involve the USD. Okay, not just major pair, and also like I say earlier, the gold and also the oil, and the latest darling in the financial markets, the cryptos market like BTC, ETH. Mostly they are traded against the USD, or they call it USDT, which is a kind of stable coin. But the stable coin is also paired up with the USD, right? So at the end, people will just also use the USD to value it. So USD is definitely very, very important. So how are we going to assess the value, the strength of the DXY, the dollar index, right? Mainly, of course, there are lots of factors, on everyday basis that will actually have an impact on the dollar, okay, on the strength of the dollar. But I would just narrow it down to main three factors, or the main three data that you can always keep an eye on if you really want to trade, and you want to trade the things that will be involving the dollar, right? Okay, unless you are trading some pairing like GBP EUR or like GBP JPY, then perhaps you don't need this. But I think most of the time, the things that we trade definitely involve USD. So yep, first of all is the GDP, the gross domestic product. So the GDP here that I'm talking about is the US GDP, right? So obviously it is the one key economic data to let us know what is the economic status, the economic condition in the US. So it is very easy to understand when the GDP is good, okay, is or higher than the previous reading, or higher than the what the market is expecting, which means that in a layman term, the US economy is doing better than what the market is expecting. So it will drive the dollar to higher, or strengthening the dollar. Okay, so I think every month we will get this GDP data. Okay, cannot remember what was the latest number, but if you have been keep yourself updates with the US economic data regarding any other data. Overall, I would say despite the Federal Reserve has been increasing the interest rate, has been sort of discouraging more economic activities from happening, but relatively US economic is still doing well, and of course it also reflects on the recent US equities market performance. So if you have been trading the US equities market, or you have aware, or have keep yourself updates, you can tell the US equities markets or the indexes has been challenging their all-time high. Okay, especially the Dow Jones. So GDP is one of the piece of data that actually can tell you how well the country is doing in terms of economy. So yep, GDP is one of the key data that will tells you about whether or not which direction the DXY is going to go after the review. The next thing is the employment. So obviously when the market is doing well, when businesses is doing well, they want to expand, definitely they will need more manpower, they will hire more people. Okay, or if the GDP is going up, it means like more people is consuming, they are spending money. So in a way, employment should be good. So when you look at the employment, and of course everyone in especially if you're trading forex, you definitely will come across this non-farm payroll. Okay, non-farm payroll is the one piece of a job data from US. So of course we have a specific webinar to talk about NFP. So if you don't know about it, maybe you can join us next time, but I will not go into detail. But other than NFP, we do have other job data like initial jobless claim, like unemployment rates. So those are the job data that will somehow will have a direct impact on the DXY or on the dollar strength. So why it is? So when you see the employment is good in general, so if you compare to previous reading, or like quarter to quarter, or you compare it with what the market consensus. So let's say if I'm not wrong, I think last for the latest NFP, I think that people are expecting like 20 something K of the NFP, but the actual number came is 216, if I'm not wrong, K of NFP. So definitely is to tell us that the job markets in the US is still remain robust. A lot of people getting job. So when they get job, they're able to spend. So it in a way they will stimulate the the GDP, okay, as a result. Or if you look at it from the business perspective, why are people getting job, or why is like the initial jobless claim go down, or the unemployment rate stable or going down? It means that more and more people are getting job. So why are they why is this happening? Is maybe because the businesses are expanding, so they are doing well. The US businessmen, they are doing well. That's why it caused leads to this kind of thing happen. It's reflected in this employment data. So obviously when you look at this data, when the employment data or the job data is good, it's doing better, or it come upbeat, you can tell that the dollar will it will fuse the dollar to trade higher or boost the dollar strength. And then after that, you can apply it accordingly. That depends on what you trade. Then if you trade on gold, then perhaps you need to have a inverse relationship, or otherwise then you need to think of it, what's the relationship between dollars and other things. Okay. The thirdly will be the inflation. So we have various gauge for the inflation. Okay, mainly is the CPI and PPI, and also PCE. So CPI is very a common inflation data that I think most of the country will publish it, like Euro, UK, China, everyone is publishing the CPI. Okay, so why inflation is important is when you see inflation, I would say 3% or lower, it is good, it is healthy for a country. So because we need progress, we need our economy to expand. So definitely we will leads to an inflation to happen. But what if it's too high? Then this is not good. So if you are from Euro, if you are from US, or I think most of the country, actually we are suffering from the high inflation since 2022. Okay, I think since the start of 2022, the inflation rate has been climbing. So if you are from Euro, if you are from US, definitely you can feel it. It's so suffering. I think when the inflation rate reaches peak, is up to double digits, like 10%. It means that when you earn your salary, when you got your money, you have to deduct like 10% in the value, because the thing just got 10% more expensive than before. So for example, when you buy buy yourself a lunch at $10, but when the inflation hit with 10%, then now you need to buy your lunch at $11 already. Okay, so your money is actually devalued when the inflation is high. So when this happen, when the country is facing this inflationary pressure, what's the government do? So they will try to discourage the economy from expanding. They want to have a post. So what they do is to discourage you from spending, from the business perspective, as also from the retail, from every single consumer. So they will increase the interest rate. So when they increase the interest rate, the cost of borrowing goes up. So when the cost of borrowing also goes up, at the same time, you will earn interest if you put your money in the bank. So you will tend to save more, and business will tend to maybe defer their investment for further expanding their business. So the government doing this is to want to keep the inflation lower and lower to their favorable rate. So in UK, in Euro, in US, theirs targeted inflation rate is at 2%. So, but if at 3% is still manageable, it's still okay, like below 3%. So if it's above 4 or above 5, it is considered a very high inflation. So definitely the government will come and step up and do something. So yeah, when the interest rate is increasing, it will lead to an appreciation for the currency. So for example, let's say only Eurozone, the Euro economic bloc, they're having this inflation risk. Their inflation is very high in the region, but nothing happened in the UK, nothing happened in the US. Is just life goes on, and the ECB, the European Central Bank, they want to leave the interest rate higher because they want to control the inflation. So from here you can know what happened. Euro inflation is high. Their central bank will leave the interest rate, so they will lead to an appreciation for the euro. And if you're trading, let's say Euro USD, if you compare these two currency, US nothing happened, so definitely euro will goes up because euro having inflation, or vice versa. Now let's say UK is normal, US having a very high inflation, okay, and the Federal Reserve come out and they want to increase the interest rate. What will happen if you're trading GBP USD? It will go on another way, where the pair will go down, because nothing happened with UK, nothing happened with the pound sterling, but the USD will appreciate, goes up, the DXY will goes up, so it will goes down. Okay, so this is the relationship. So, and after that, when you know all these three things, that is still not the ultimate thing that you want to know, because after all these three data, we got it and we just give a guess. This is just a tool, just an assessment tool for us to guess what direction the DXY is going to go, because ultimately there's still one institution in the US. I would say maybe not 100% correct. They are the one that can single-handedly control the value of the dollar, which is the Federal Reserve. So our Federal Reserve is the central bank for the US. So the main, I would say, the main mission for them is to oversee the inflation or deflation situation in the country, and from there they will try to manipulate it by setting interest rate or managing the money supply to find a balance between economic growth and the pricing pressure. So they need to find this nice balance. For them, the benchmark will be at 2%. So they love to see the inflation, the US inflation, to stay at plus minus 2%. But at the moment, I think the latest US CPI came quite high. Actually has a sign of rebound above 3%. Okay, which is why suddenly you can see the dollar actually climbing. The DXY is climbing. So later we will discuss it. Okay. Yes. So this is one of the key jobs. Okay. This central bank, they will try what the tool for them to control, to tackle the inflation, or even when the deflation hits. This is what they do. They will manipulate the interest rate level. They'll manipulate the short-term a loan rate, or they call it the Fed rate, so that other interest rate will follow this benchmark rate. And from there, if let's say they increase the interest rate, it will lead to lower money supply in the markets, because everyone want to keep the money, everyone to put their money in the bank. Okay, and then less people want to borrow, because the borrowing is higher. So let's say, for example, in early 2022, the interest rate in the US is near to zero, or is zero. And up to now, at the moment, the interest rate in the US is 5.25 to 5.5. It means that last time when you make a loan, you really no need to pay. There's almost no cost for you to make a loan, but now you need to pay 5% of interest if you make a loan. So it's in a way discouraging people from make borrowing from the bank. That's why so when the interest rate is getting higher, it will lead to an appreciation for the currency, because I would say in the economic term, interest rate is the price for money. When the interest rate goes up, the currency will appreciate. Okay, so of course, when the inflation is not, it's like lower than 1%, this is also not favoring the country, it's not favoring the central bank. From there, then maybe they will need to cut the interest rate. This is of course, now at the moment, what's the market is expecting? They're expecting the the Federal Reserve to start cutting rates, because they want to avoid the market recession, the economic recession from happening, because interest rates is like now, the highest level in decades. This is like never before, because last year the inflation was very, very crazy, double digit. So I think at the moment the Federal Reserve has done a great job, but still yet to reach the level that they want to see, which is at about around 2%. Okay. So after we know that, they are the institutions that can actually manipulate the value of the dollar. So what we want to see, what we can watch out after that, we can trade well by knowing based in general what's the direction the DXY tends to go. So these are the things that I would say is very, very important if you are trading dollar related things. Okay. The first one is the speeches from key central bankers. This here is the central bankers. Here we're talking about the Federal Reserve. So if you read the news, or even you trade on the news, yesterday we have the Federal Reserve Governor Christopher Waller. He come out to say something, I would say a mix, but markets have a hawkish narrative for his statement. So he says something like, at the moment, the Federal Reserve have to be more cautious if they want to talk about rate cuts. But he didn't rule out. He said that there's still chance, there's still possible that the Federal Reserve might start to cut the interest rate in this year. So at first, the markets when we step into 2024, the market participants or the traders, we are expecting the Federal Reserve to start cutting rates in March. But after what he said yesterday, let's just make people think that, oh no, this is not coming so soon. Perhaps later, or like second or third quarter in this year in 2024. That's why it drives the dollar to trade higher. So high, I think I can't remember how many percent, but yeah, it's the highest levels in 2024. So what's the the key member or the keyboard member from Federal Reserve speak or talk in the public? It will have a very direct impact on the dollar strength. So Jerome Powell, all the board member, and yeah, and also the US Secretary of the Treasury, Janet Yellen. So what she speak is also sometime will have an impact on the dollar as well. Okay. And the next thing is the meetings minutes. So under Federal Reserve, they have this committee called Federal Reserve Open Market Committee. So they are the one that actually come together, have a meeting. After that, they decide the monetary policy for the US. So at the end of every FOMC meeting, they will always come up with this meeting minutes. So in these minutes, after we read it, or even when we look at the news, we see this highlight. People will have their own perception on their meeting minutes. So we gather all the sentiments in the market after they read this meeting minutes. They will come up with a narrative. So whether this is a hawkish one or a dovish one. A hawkish one is mean that they want to have a more aggressive approach in terms of monetary policy. It means increase the interest rate. A dovish one will be on the opposite side. It means that the Federal Reserve might want to start cutting rates or want to maintain the interest rate at a lower level. Lower level is means like 1-2% or even lower, or 0 point something percent. Okay, this is like a dovish side. Hawkish side is on the another way around, like 3%, 4%, or 5%. This which is like what is happening now, because yes, last year the inflation rate is still very, very high, which is not healthy for all the economy, including in the US. So yep, meeting minutes is one of the key things that we really want to focus on. But of course, not everyone gonna read every words to words in the meeting minutes. But sometimes we just wait for the news and see what's the direction, what's the upcoming monetary policy move is going to adopt by the Federal Reserve, and from there we trade accordingly. Okay, then we can slightly guess what's the direction for the DXY, and after that we apply accordingly to the things that we're going to trade. Okay, and then lastly is the interest rate decision. So every month, I think almost everyone every month, of course it's not, because after 30th of January, the next interest rate decision from the Federal Reserve will be in March. So they skip the February one. So it's almost every month, but it's not true. Okay. So when we look at the interest rate decision from there, definitely it will definitely have a very, very direct impact on the dollar. So when we see they say they want to add another 25 basis point, 50 basis point to the interest rate, then it will directly leads to appreciation in of the dollar. The DXY will straight away goes up. Or after that, if I say they want to maintain the interest rate, or they want to start cutting the interest rate by 25 basis point, by 50 basis point, then you can expect a straight plunge, a slump of the dollar. That direct. Okay, so these are the three things that I can think of that you have to definitely pay attention on, regardless of what thing that you are trading. Okay. So yep, these are the things that you definitely want to pay attention. Okay, and then yeah, what is the DXY? What's the dollar index? So the dollar index itself, like a dollar is a dollar if you are not comparing it with another currency. So the DXY is the dollar index that compare with 6 currencies altogether, but the weightage is different. The euro have the highest weightage, which is about 60%, and then you can look at the chart on the right side. Okay, you can apply it accordingly. So when you look at the dollar, the DXY is going up. Which currency have the biggest impact? Definitely will be the euro. So you can use the DXY. Well, after that you can apply it to the euro. To be more effective. Okay, because it has the highest weightage. Okay, the dollar index is the measure the value of the USD with a basket of 6 currency. Okay, this is just to let you guys know so what is the dollar index. Okay, and moving on is gold prices and the relationship with the dollar. So gold price itself is have a very unique characteristic. So we often call it as a safe haven asset. So it often have appreciate in value when there's something happens in the markets where we don't know what is the aftermath, what is the result. For example, in 2008 when the financial crisis, or last time when we have the Ukraine and Russia war, and also when we have the banking crisis in the US, and then we have the crypto markets issue, the bank fragment when he's have the scandal. Often during this kind of period, gold price will go up when the time in the time of uncertainty. So yeah, because of its unique safe haven specification. That's why yeah. But we know that gold itself, there is no any interest bearing with it, which means that if you are, for example, if you're holding bond, if you're holding equities, if you're holding currency, it will generate you return by itself because it is, it bears the interest. So for bond, we have the like treasury yield, we have bond yield. Equities, we got like dividend. Okay, or if your the counter the company's shares that you hold paid out dividend, you got dividend. And like currency, if like now the US interest rate is at 5%, so if you own US dollar, when you put it in the bank pay you 5% of interest rate. So you got return itself by holding the assets, but gold itself doesn't provide you any return. Gold is just gold, but the value is depends on, I would say, the status in a global markets, what's going to happen next. So when during the peacetime, people will not go to gold. People will go to other like risky asset, like maybe the equities markets. Okay, or only during those periods where people when we have the black swamp, we don't know what's going to happen next. Like last time when we hit by the COVID pandemic, yeah, and then gold price might goes up, temporarily. So yeah, because normally gold price XAU is denominated in USD. So what happened with the USD will have an inverse relationship with the gold price. So when you see the DXY goes up, in a normal situation, gold prices will tend to go down, or vice versa. When you see the dollar depreciate, the DXY goes down, gold price tends to go up. Is beautifully exhibit from the yesterday markets, or even last 2 days markets, when the dollar actually appreciates strongly, goes up very high, and at the same time you see the gold prices actually plunge. So again, you can also watch out the 3 factor that I discussed with you guys earlier to assess the value of the dollar, and after that you can apply it to XAU, to the gold price, because it has a direct inverse relationship. And yeah, and after that, after you got all these 3 data, you know what to do if you really want to trade on gold. Okay. And moving on for the crude oil. Crude oil is not so obvious like gold because it is useful, right? So in the markets, generally we have two types of crude oil prices. One is called Brent and one is called WTI. So yeah, Brent is a global benchmark, where WTI is regional, is from the US, is for the America. So it does affects by the macro factor, which is the global economy, the monetary policy. So remember, just like I say, when the economics, in general, everyone is having this inflationary pressure, inflationary risk. When all the major central banks are having a very high interest rate, they are having this monetary restrictive policy. What they do is they discourage economic activities. So we know when we have production, when we have shipment, when we drive, when we fly flights, all demand for oil. So when the government having this high interest rate and discouraging economic activity, it will harm the demand for the crude oil, for example. So when this happening, then you can expect the crude oil prices to drop. Okay, so the monetary policy is one of the key factor that will have an impact on the oil prices. Then the next one will be the global demand and supply. So for example, here is like recently, since after the pandemic, because we know China and India, they are the top importer in the world for crude oil. So they use a lot of crude oil. So when China and India, they have to tackle the pandemic. They're fighting the pandemic. They want to lock everyone at home. So their economics is being harmed by the pandemic. Then the demand for the oil, you can tell, is definitely not going to be good. So at the time, it means that the crude oil prices will not be good as well. Okay, so this is the demand side. Supply side, definitely we need to look at OPEC. So because OPEC is one of the biggest oil cartel in the world, so they are controlling the supply. So and also including US, they have ample supplies of crude oil, and I think Brazil. So we have to look at their inventory data, their supply data, their oil shipping data to actually gauge the oil prices. Sometimes we can get this data, right? Okay, so we need to always look at the two major factor, the demand factor and also the supply factor, in order for us to trade the crude oil. But of course, crude oil is also denominated in USD. So when like in a peacetime, when the OPEC doesn't have a very big policy, or when the economy is still doing well, the monetary policy is okay, it's like in a expansionary monetary policy. So then we have to look at the strength of the dollar as well. When the dollar is more expensive, it will have a negative relationship with the crude oil. So vice versa, when the dollar is cheap, so it means that the oil price is cheap, you will encourage more people to buy it and will lead to the oil price to goes up or trade higher. Okay, this is the relationship between crude oil and the dollar. Okay, moving on. This is the economic data especially from those economic data that from US up to next Friday. Okay, some of the things that you can mark down. The retail sales is going to due, I think, in a couple more hours. Okay, so this will have a direct impact on the dollar, the DXY, because retail sales is to reflect how many people are actually buying. So when you see the retail sales goes up, which means the consumption in the US is good. It means that it reflects that the economy in the US is doing well. So when the retail sales beats the expected number, it will lead to appreciation for the dollar. And this is actually going to coming out soon. So if you love to trade on news, you can watch it up. And the next one is the job data. Remember, we talk about employment. Okay, so yeah, initial jobless claim is the job data. Is those that lost their job for the first time, they can get this claim from the government. So from there also, we can see how many people are actually losing their job. Is the number increasing or decreasing? So if the number is increasing, it means that more people losing their job. The job market is softened. So it means that it tells us that the economy is not so robust now. Means that the inflationary pressure in the US is not not so pressuring. So it will lead to depreciation in the of the dollar index. But if the initial jobless claim comes up no lower than what's the market expected, then yeah, another round, the dollar will actually appreciate. And the next one is the crude oil inventory. This is the weekly data. So this is to assess the oil demand in the US. So when you see there's a huge increment in the crude oil inventory, it means that less people are using oil. So they store their oil in in a garage, so it means that the demand for the crude oil in the US is dropping, so it will lead to a lower oil price. So again, if you see like a huge decline in the crude oil inventory when the data published, so you can tell the demand for the crude oil is picking up, so it will lead to a higher oil price. The oil price will goes up. Okay, so these are going to deal on Thursday, tomorrow. Okay, this crude oil inventory. Then another one is the PCE price index. So just like I say, for the price, the inflation gauge, we have CPI, we have PPI, we have PCE. So PCE is the Federal Reserve favorite inflation gauge. So they often look at this PCE price index to assess the inflation situation in the US. So the previous reading was 3.2. So this is going to due on next Friday. So if the numbers coming up is like no higher than 3.2, it means the country is still have to deal with the inflationary price risk. It means that the Federal Reserve have to do more jobs to tackle the inflation issue. Okay, so again, it will definitely leads to an appreciation of the dollar. So you can expect the DXY to actually goes up, trade higher. Okay, but this is due next Friday. And of course, we have also the US GDP, which is due next Thursday. So these are the key key economic data that you want to mark down if you want to trade